Welcome to Finance Trice, the world's modern broadcast hub for all things finance. From investing strategies to economic updates, from crypto insights to real world money lessons, every broadcast is designed to help you think smarter, plan wiser, and grow.
Dramatic cinematic voiceover. They exist on the fringes of legitimate finance, these manifestos. They circulate in the low-light corners of the internet, whispered by those who claim to have transcended the market's chaos. The promise is always absolute, a shortcut to certainty, mastery, and permanent freedom. But never has that promise been delivered with such brutal, almost poetic brevity. We were handed the source titled Excerpts from Mastery of the Financial Market Flux, and from it, 3 phrases, 3 claims that form a complete philosophy of financial conquest. Finance, buy, sell tricks, advanced level, every time income, every life easy. That's it. 14 words that promise the ultimate financial cheat code. Today, we are conducting a full-scale forensic deep dive into those claims. Our listener, the learner, is intensely curious, wanting to know, is this a utopian fantasy, a sophisticated fraud, or does it hint at a truly revolutionary understanding of the market?
It's a fascinating investigation because this text it demands that we contrast minimal input with maximum output.
Right.
The claims are so simple, but the conceptual hurdles they imply are just colossal. You are essentially asking us to reverse engineer a financial utopia from a handful of words.
And that is precisely our mission. We are here to unpack the meaning, the feasibility, the psychological impact, and the ethical footprint of this cryptic manifesto, transforming these sparse declarations into maximum actionable understanding. We are treating this text as 3 interconnected conceptual pillars that map the journey from strategy to life transcendence.
Pillar 1 is the method. Finance, buy, sell tricks, advanced level. That's the strategic foundation.
Okay.
Pillar 2 is the implication. Every time income. That's the statistical result. And the final pillar, the ultimate outcome, every life easy, the promised lifestyle.
Okay, let's unpack this. We start at the source of the claimed power, the methodology, the promise of the method. You know, when you hear the word tricks in the context of high finance, it just sets off alarm bells, doesn't it?
Immediately.
It frames the market not as this complex, adaptive ecosystem, but as, I don't know, a rigid structure just waiting for a hacker to find a loophole.
Exactly. And it taps directly into this pervasive public misconception that success in high finance is achieved through secrets, not through skill or grueling work.
The myth of the magic key.
It's the enduring myth of the magic key.
Right.
Most people believe, that institutional investors possess some secret playbook full of hidden tricks. When in reality, truly sophisticated finance is built on, relentless risk management, statistical advantage, technological infrastructure, and critically, this mechanism called arbitrage decay.
Okay, that concept, arbitrage decay, that is the central counterpoint to the entire idea of a perpetual trick. We need to really define this for you because it explains why permanent advantage is structurally, almost impossible in an efficient market.
So think of arbitrage as a pure profit opportunity. A literal free lunch. Imagine you could buy a share of stock A in New York for exactly $100 and instantaneously, at the exact same moment, sell that exact same share in London for $100.05.
Okay, so 5 cents, no risk.
That 5 cents is risk-free profit. That's a trick. That's the kind of thing this manifesto is promising.
Right. But the moment that discrepancy is noticed, what happens next is what the manifesto completely ignores.
Exactly. The moment that price difference appears, quantitative funds algorithms, their whole job is to detect that inefficiency.
And they are incredibly fast.
I mean, we're talking about milliseconds. They are programmed to exploit it instantly. So they rush in, executing millions of trades, buying in New York, selling in London.
Flooding the system.
And that massive volume collapses the price difference back to zero almost immediately. The trick is monetized, yes, but in the process of monetization, the opportunity, it destroys itself. The advantage has vanished. It's gone.
It's a self-destruct mechanism. So the claim that someone has a static trick that continues to work suggests either they are the only person on Earth with that information,
which is highly unlikely,
or the market they're operating in is just so shallow, so inefficient that this decay mechanism hasn't been allowed to work yet. Maybe a really obscure crypto coin or something.
That's the friction point.
Yeah.
Modern markets, the S&P 500, Forex, they are deeply, deeply efficient. Any trick is temporary. It's a fleeting informational advantage. And what's more, the manifesto claims this trick is at an advanced level. That term itself needs investigation.
So what does advanced level truly mean in the world of professional finance? It can't just mean, knowing a few chart patterns.
No, absolutely not. Not even close.
Yeah.
When you discuss advanced level strategies with, say, genuine high-frequency traders or institutional quantitative managers, you're discussing strategies that involve incredibly complex mathematics.
Like what specifically?
We're talking about dynamic hedging, complex derivatives pricing models. Things like exploiting minute structural differences in the way orders flow across different exchanges, or leveraging behavioral economics insights on a massive, statistically proven scale.
So we're already far beyond a simple buy low, sell high indicator. If this trick is real and it is advanced, it has to contend with the realities of modern market infrastructure. Hashtags, scientific, technical explanations, conceptual.
Right, and if the core claim is a buy-sell trick, it implies perfect, systematic market timing. To achieve that consistently, the conceptual hurdles are just immense, and they often revolve around two things: speed and data processing.
We often talk about information asymmetry, having a clear information advantage. But you're saying the sheer speed of execution can become the dominant factor, almost rendering the information secondary.
In many cases, yes. That's the structural reality today. The signal itself is often less important than the speed of your response to it.
Can you give us an analogy for that?
Sure. Imagine a horse race where all the horses are genetically identical. They all run at the exact same speed.
Okay.
The critical advantage isn't the horse. It's the proximity of your starting gate to the finish line. Or the fraction of a second can shave off the reaction time of the jockey. That's what high-frequency trading has become.
So if this trick generates a perfect signal, let's say buy stock B now, but I'm sitting here executing that trade from my home computer, and a quant fund with servers physically located 50 feet from the New York Exchange gets the same signal.
And executes milliseconds earlier.
The opportunity is gone by the time my order even reaches the market. The time window itself is the bottleneck.
Precisely. That's called latency, and it is a battle for microseconds. And an advanced level strategy isn't just about knowledge. It's about infrastructure, it's about dedicated fiber optic lines, and it's about physical location.
So the trick becomes this engineering marvel designed to exploit structural inefficiencies, not just behavioral ones.
Yes. And for you, our listener, understanding this means realizing that the trick may cost hundreds of millions of dollars to implement and maintain. It would involve dedicated proximity servers, not just, a software you can download for $99.
That creates a massive barrier to entry that the manifesto just conveniently ignores. Let's shift our perspective for a moment. If the trick isn't purely about technical infrastructure, how else can we interpret the word advanced? Hashtag, multi-perspective storytelling, interpretation of advanced.
We can interpret advanced through two dominant lenses in modern finance: the technical lens and the behavioral lens.
Let's start with that cutting-edge technical perspective. This feels like it's moving beyond human intuition entirely.
It is. So perspective one, technical mastery through automation. In this view, the advanced trick isn't a strategy a human even devised. It's a pattern that was discovered by machines. Exactly. It's leveraging artificial intelligence and machine learning to process petabytes of data streams a human brain could never comprehend, and finding predictive correlations in that noise. The trick itself is essentially an automated black box.
Can you give me an example of the kind of data we're talking about here? It's not just earnings reports and PE ratios, is it?
No, that's basic. We're talking about processing non-traditional data streams. They call it alternative data.
Okay.
Think about models that correlate traffic density in the parking lots of major retailers with upcoming sales figures, or models that scrape global satellite imagery to predict crop yields long before the official agricultural reports are released.
Wow.
The trick is the algorithm's ability to synthesize all these disparate inputs into a short-term price forecast that is consistently accurate, and then execute on that forecast at lightning speed.
So that implies the trick is constantly evolving, constantly learning. It's not a static secret, it's a dynamic computational advantage. But, finance is also fundamentally about human emotion, fear, and greed. Where does the behavioral interpretation fit into all this?
Right, so perspective two, behavioral mastery through exploitation. Markets are meant to be rational, but they are populated by emotional, often irrational participants. This advanced trick could refer to the systematic exploitation of mass human fallibility, what we call behavioral biases.
So in this model, the advanced trader isn't trying to outmath the market. They're trying to outweigh or maybe counteract the human consensus.
Precisely. For instance, think about the herding instinct, that tendency of investors to panic sell when they see others selling, which just amplifies volatility.
Right, the cascade of fear.
An advanced behavioral trick would be a system that identifies when a market correction is based purely on that fear rather than on fundamentals. And then it would systematically bet against that fear. It requires immense psychological discipline to be the one buying when the entire world is screaming, sell. And that discipline itself becomes the consistent source of alpha.
So this means the advanced level is either inhuman speed and data processing, or it's superhuman emotional control.
That's a great way to put it.
And both of those are incredibly difficult to achieve. The manifesto, though, implies a clear path to getting there. #TagShack step-by-step journey process, conceptualizing mastery.
The structure of the phrase itself, finance, buy, sell tricks, advanced level, it suggests a kind of structured progression, a journey that any learner must navigate to reach mastery. It's a transition from just basic understanding to, well, to a real competitive advantage.
Let's lay out this conceptual journey. What does the entry-level stage 1 look like?
Stage 1, basic knowledge. This is the survival stage. You understand the language, what a stock is, the difference between a market order and a limit order, the concept of risk and return. You are functionally literate in finance, but you have no edge, none at all.
So you're playing the game, but you don't know the rules well enough to win consistently. You're just participating.
Correct. Then comes stage 2, competence. This is where most serious retail traders operate. You understand fundamental analysis, technical analysis. You have risk management protocols like sizing your positions, diversifying your portfolio.
You can make money, but you're also losing money. You're subject to the market cycles.
Exactly. You have small, temporary edges, but you still experience significant drawdowns. You might understand why the market moves, but you can't consistently predict the when.
And then stage 3, the promised land of the manifesto.
Stage 3, the advanced level. This is the discovery or creation of that consistent, repeatable, systematic alpha source. You've moved beyond competence to competitive dominance. The trick is formalized.
So whether it's your infrastructure or a patented algorithm or maybe a unique behavioral framework, it generates statistical success over all relevant timelines.
Right, and the focus shifts from just trying to make money to scaling that systematic advantage.
You know, the journey itself contradicts the simplicity of the word trick. It implies years, maybe decades, of study and failure and refinement. And this systematic advantage, this power, it must lead to the second, and I would argue most dangerous, claim of the manifesto, every time income. So if the first pillar is about strategy, the second one is about statistical reality. Every time income. Not consistent income, not high probability, every time.
That's absolutely.
I mean, zero losses, zero volatility. In finance, this sounds less like a trick and more like you're breaking the laws of physics.
You've hit the core tension of the entire manifesto. The claim, every time income, is a quantitative impossibility in any non-manipulated, non-collapsing efficient market. It just is. So we have to introduce the fundamental financial concepts that this phrase actively denies. #tag real data and references, the zero-risk fantasy. Let's start with risk. In finance, risk is defined as volatility, the deviation of actual returns from expected returns. The foundational relationship, the thing you learn on day one, is that higher return must come with higher risk. It's the trade-off.
There's no free lunch.
There is no free lunch. So if you claim every time income, you are claiming the elimination of volatility and risk entirely. You are predicting the unpredictable.
And the standard measure for comparing returns against the risk taken is the Sharpe ratio. Let's just make sure we're all clear on why this ratio is so critical here.
The Sharpe ratio basically measures the performance of an investment by adjusting for the risks you took to get that performance.
So it's a measure of efficiency.
It's a measure of efficiency. A higher ratio means you got a better return for the level of risk you took on. A ratio of 1 or higher is considered good. A 2 is excellent. Top-tier hedge funds might aim for a 3 or a 4 in a great year.
Okay, so a strategy claiming every time income effectively claims zero risk, zero volatility in the denominator of that equation.
Which mathematically pushes the Sharpe ratio toward infinity.
An infinite Sharpe ratio. That doesn't just suggest superior trading, it suggests an act of, financial omnipotence.
It does. And we see the lie in this when we look at the concept of drawdowns.
Right.
A drawdown is the peak to trough decline your portfolio experiences during a certain period. Every legitimate solvent trading fund, even the most successful ones in history, has drawdowns. They have periods where they lose 5%, 10%, even 50% of their capital before recovering.
So claiming every time income means you have somehow eliminated the inherent uncertainty of global geopolitics, economic shocks, unexpected regulatory changes,
And even the simple error rate of your own execution systems. A fat finger trade, a server going down.
If you look at the track record of any revered real-world investor, a Warren Buffett or Ray Dalio, they have endured terrifying periods of loss. The very existence of these losses confirms that financial uncertainty is structural. It's a feature, not a bug.
So a system promising every time income is either operating completely outside of the conventional market, or it is fundamentally concealing its true risk profile from you.
The only way to truly guarantee income every time is to operate in an environment where your input completely determines the outcome.
Which means you are either the market itself or you are manipulating it. #tag cause and effect analysis.
Okay, let's continue to treat the manifesto as a challenge. If we assume, just for the sake of argument, that the advanced level tricks genuinely achieve every time income, what are the unstated necessary preconditions? What must be sacrificed or restricted for this mathematical impossibility to hold true?
There are 3 critical constraints that this level of certainty imposes. The first is what I'd call the scalability paradox.
Scalability paradox.
Okay, condition 1. Market constraint and scalability. Guaranteed income often works brilliantly on paper or with very small amounts of capital. The moment you try to scale the operation to the size required to fund every life easy, say, billions of dollars, your trading volume itself becomes a market-moving event.
So your own trades start to affect the price.
Your guaranteed trade instantly moves the price against you, which reduces the arbitrage or the advantage to zero. The snake eats its own tail.
So the very act of trying to make enough money to retire on breaks the system. You become too big for the trick to work. The income is guaranteed, but functionally it's limited.
Exactly. The trick works beautifully until you actually need it to work big, which leads to precondition 2, information monopoly. If you're winning every single time, you must possess information that literally no one else has access to continuously. And this is where we start blurring the line between predictive analytics and outright insider information.
And that brings us directly to the third precondition, the legal and ethical red flags that such certainty automatically raises.
Precondition 3, legal compliance and boundaries. A consistent, non-volatile stream of income in a chaotic system. It suggests a structural advantage that may well be crossing regulatory lines. Does the trick rely on exploiting some fundamental vulnerability in an exchange's infrastructure? Does it skirt the rules of front-running? #tag ethical and legal cautions.
Let's talk about that for a second. The inevitable scrutiny that every time income would generate. Regulatory bodies are designed, at least in theory, to ensure market fairness. What happens when a system defies the odds so completely?
The moment guaranteed returns are advertised, the regulatory spotlight is on you. Groups like the SEC in the US or the FCA in the UK are highly, highly sensitive to 2 things. Systems that rely on non-public material information.
Classic insider trading.
Right, and something a little more subtle, structural market abuse.
Can you give us a detailed example of what structural market abuse might look like in this context?
So structural abuse isn't the traditional, CEO tells his friend to buy stock before an announcement. It's leveraging infrastructure to unfairly front-run other market participants.
Okay.
For example, there have been regulatory actions taken against high-frequency trading firms that develop specialized colocation servers and proprietary data feeds that effectively allowed them to see the incoming order flow just fractions of a second before the rest of the market.
A tiny head start.
A tiny head start that is everything. Now, it's not technically illegal insider trading, but it is leveraging technical infrastructure to create an unfair, guaranteed advantage over slower, human-driven systems. If the manifesto's trick is real, it must be exploiting an edge so sharp that it functionally behaves like market manipulation, even if it's currently legal in some gray area.
And if the trick is advertised widely, which the very existence of this manifesto implies it's meant to be, it starts to look like something else entirely. It starts to look like a Ponzi scheme.
That's the historical reference point.
Yeah, right. Where the only way to sustain the every time income is by bringing in new capital from new investors to pay the returns of the old investors.
Every single publicized system that has ever promised non-volatile guaranteed returns has historically collapsed into either outright fraud, like the infamous schemes we all know, or massive technological failure when exposed to unexpected market conditions. If this system operates legally, it must be silent, small, and non-publicized, which contradicts the very nature of a manifesto.
Let's shift away from the external constraints for a moment and look inward. What does expecting guaranteed success actually do to a trader's mind? #tag psychology and emotional simulation. We often say that success in trading is maybe 80% psychology. In conventional trading, fear of loss is essential. It's what prevents you from over-leveraging. It forces disciplined risk management. If every time income is achieved, that primal motivator of loss is completely removed from the equation.
The psychology of the guaranteed win is a double-edged sword. On one hand, yes, it removes crippling anxiety. It must be very calming. On the other hand, it fosters an extreme cognitive bias, the illusion of control. The trader stops questioning the system. They stop researching the market. They become entirely reliant on the trick.
So it's passive adherence replacing critical thinking. They are no longer traders. They are merely operators of a black box that they no longer understand.
And this creates a radical emotional fragility. The system's robustness is never tested because the trader stops preparing for failure. So when that first inevitable loss finally occurs, even if it's a minor system error or some black swan event that temporarily neutralizes the trick, the psychological shock is total.
Because it shatters their core belief.
It shatters the core belief in certainty. They might panic sell the entire strategy, abandoning the trick just as it's about to recover.
They weren't prepared to handle volatility because they were told they had conquered it. It creates this psychological dependency that is ultimately more dangerous than the market volatility itself.
It really is. The mantra, every time income, is a powerful psychological balm, but it's one that actively discourages the development of genuine mental toughness.
And it sells certainty in a chaotic world.
And that psychological premium is high. It allows you to outsource financial decision-making, which is incredibly appealing to you, the learner, if you're currently stressed by financial complexity.
But once that magical certainty is achieved, once the mechanism of guaranteed income is in place, the focus naturally pivots. The means justify the end, and the ultimate end is the third pillar. We move from the sterile language of P&L statements to the lush, almost cinematic promise of existential fulfillment. Every life easy. For you, the learner, this is the ultimate draw. This isn't just about money. It's about transcending daily friction. #tagged emotional engagement and cinematic scene descriptions. I can picture the scene so vividly. It's not about owning 15 yachts or a private jet. It's about the total detachment from the clock and the calendar. The day is structured purely by intrinsic desire. You wake up naturally, not to an alarm. You check your screens, and the P&L confirmation emails is just a footnote. A boring little email confirming the status quo. The market's chaos is a distant, completely irrelevant noise.
The easy life is a life of total optionality, and it's secured by this permanent financial scaffolding. The key components aren't luxury goods. They are freedom, security, and the elimination of the scarcity of time.
Time, right, that's the real currency.
It is. If every time income is working, the individual is insulated from all major external stressors, recessions, job losses, unexpected medical bills, all those things that keep the rest of us up at night.
Which means replacing obligation with pure choice. Do I want to travel the world today? Do I want to dedicate my time to studying philosophy? Do I want to simply spend time with family without that ticking clock of future financial strain in the back of my mind? The limiting factor is no longer the balance sheet. #tag character backstory integration. Learner's motivation.
And we have to connect this promise directly back to the listener. Why do you, the learner, seek this knowledge? It's because the phrase, every life easy, addresses that deep-seated motivation to eliminate friction and pressure. Financial pressure isn't abstract. It's a tangible physical stressor.
It absolutely is. It affects your sleep, your decision-making, your relationships. The learner isn't just seeking wealth. They're seeking the absence of stress that they believe wealth will promise them.
This manifesto is highly effective because it sells a psychological state, a state of relaxation, not just a dollar amount. The hope is that by mastering this one trick, the one major source of global complexity money will be solved, and consequently, all other life complexities will just naturally be simplified.
The goal of an easy life becomes the ultimate single simplifying principle for life management.
A single focal point.
And this singular focus on ease can be incredibly seductive. But we need to apply our critical lens here as well. Is financial ease truly equivalent to existential ease? #tag comparisons and contrasts, the false ease.
This is the great paradox. The promise of the easy life often requires the hardest, most intense work, and the result of the easy life can lead to an unexpected existential vacuum. Financial freedom is a necessary foundation for a fulfilling life, but it is absolutely not a guarantee of one.
Let's contrast the high-level, constant intellectual and technical labor required to run an advanced-level trick with the eventual passive ease that's promised. The difficulty isn't eliminated, it's just shifted forward, isn't it?
It's front-loaded. And the false ease is this illusion that removing external pressure automatically eliminates internal struggle. We have countless behavioral examples, from high-stakes executives who retire at 40 and immediately lose their sense of purpose,
Right, they're lost.
to lottery winners who become socially isolated and develop self-destructive habits. The financial problem is solved, but the behavioral traps of sudden guaranteed wealth, lack of purpose, loss of drive are amplified. They become the new problem.
So if the only metric for your success was accumulating the wealth necessary for an easy life, once that goal is achieved, the engine of motivation just sputters and dies. How do you redefine success when basic financial survival is no longer a factor?
It requires a massive shift. A shift from extrinsic, measurable goals, the account balance, to intrinsic goals, things like personal growth, contribution, legacy. The market provides the resources, but it offers zero direction for a meaningful life. The irony is, achieving the easy life might require the individual to embark on a far more difficult journey of self-discovery than the financial mastery that preceded it. #tag future vision and goal setting.
So what happens after every time income is achieved? The manifesto presents the final state as easy life, which kind of implies stasis, a finishing line. But life demands evolution, growth.
The goalposts shift dramatically. Success is no longer measured by the size of your portfolio, but by the quality of the projects you undertake, the depth of your relationships, the contribution you make to society or art. The individual has to ask, what am I optimizing for now? If my time is functionally infinite, what does a frictionless application of energy even look like?
So this phrase, every life easy, it acts as a powerful simplifying goal. It collapses all of life's complexities into one single manageable objective. But once that objective is met, the very structure of your life needs to be rebuilt, moving from, say, financial optimization to philosophical optimization.
The ultimate future vision here shouldn't be hedonism, it should be self-actualization. The easy life shouldn't mean passive existence, but the ability to pursue self-chosen, difficult challenges without the crushing pressure of financial consequence. The manifesto promises the launchpad, but the direction, the true meaning of the easy life, remains entirely up to the learner.
This has been a profound, really intensive journey. We started with 14 cryptic words and have dissected them into an entire architecture of financial strategy, statistical probability, and life philosophy. #outro. We began with the promise of absolute control over market chaos. We systematically analyzed the conceptual strategy, the advanced level tricks, and concluded there are likely not simple loopholes, but highly complex, decaying technological or behavioral systems that are constantly vulnerable to obsolescence.
We then confronted the quantitative lie inherent in the result, every time income. We established that this claim necessitates either extreme, non-scalable technological superiority or operates in a legally and statistically unsustainable fantasy realm that denies the fundamental law of risk and return.
And finally, we examine the utopian outcome, every life easy. Recognizing the deep psychological appeal of certainty, but acknowledging the profound behavioral traps that financial ease creates when it's not anchored by a real sense of purpose. And this brings us back to you, the learner. Given the market's constant push toward efficiency and the statistical impossibility of eliminating volatility, is the pursuit of absolute certainty, of every time income, a productive goal? Or is it a fundamental psychological distraction that prevents you from mastering the controlled, calculated risk that defines real financial success?
This raises the critical synthesis point. If the market is chaos and your internal response to that chaos is what defines your success, then the advanced trick isn't external at all.
The market's randomness is a perpetual force. Volatility will always exist. Any methodology that promises to eliminate that randomness is fundamentally fighting an unwinnable war against the structure of the financial universe.
And so perhaps the true advanced trick isn't finding a guarantee. Perhaps it's achieving the psychological mastery needed to execute a sound research strategy during periods of painful drawdowns when the external chaos is at its peak. True financial mastery is the mastery of self, of discipline, and the profound wisdom to accept inevitable, temporary loss as the non-negotiable cost of doing business in the markets.
So focus on verifiable principles, on process control, and on risk quantification over cryptic tricks. Critically review any system that guarantees absolute certainty in an uncertain environment. Learning to embrace calculated risk, not eliminate it, is the only true pathway to making your financial life genuinely easier in the long run.